Okay, I would like to talk a little bit about the returns on these Delaware statutory trusts now. They list returns primarily based on two things. They have what they call cash-on-cash return and a total return. So a cash-on-cash return is not the same as your rate of return. If you hear somebody talk about, oh well, the Standard & Poor's 500 return 6% this year or something like that, not exactly the same thing. Okay, so you have to be very careful about how they're defining these things and what they mean. Cash-on-cash return is your annual dollar income divided by the total dollar investment. So it's partially based on how much debt was on the property, because if you use more debt, then potentially you could get more income for the amount that you invested, but of course it makes it a riskier investment. It's listed on their returns, and I'll show you the page in the Private Placement Memorandum. It's listed as average annualized cash-on-cash return. So this could be somewhat backloaded due to the capital appreciation on the property. So if the property value went up, then it makes your annualized cash-on-cash return look better. However, I do think that they're probably trying to maintain some kind of monthly income by using balloon payments on these loans, which I talked about earlier. Let's see. Then we talk about total return. Total return calculation is used for completed programs to reflect the overall profitability of the program. So, does this mean that the real dogs aren't listed because they weren't completed? Again, we talked previously about survivorship bias, and this is a very big issue. Total return is equal to the distributions plus the sale proceeds. So it's monthly distributions plus whatever the proceeds are for selling the property at the end, divided by the amount invested, original amount invested. Total return can't properly be understood without knowing how much the monthly distributions were. But I'll show you some calculations in a minute that I was working on. Again, not the same as the returns when you hear about, say, the return on the stock market. Different calculation, shows something totally different, but we'll go over that a little bit too. What I'm seeing is it looks like a good deal of their returns, they're counting on market appreciation, which means, again, they could be backloaded. So you can have these returns and you're getting very modest monthly amount, and then hopefully the property appreciates and you get a bigger chunk at the end. But again, you have to wait. These usually go somewhere around 3 to 10 years. Some of them are shorter, some of them are a little bit longer, and we'll look at that too. So this is the page that shows a lot of the previous returns here. Okay, and as you can see, the headings, we've got your hold period, how many months they held this property. That's the life of that particular Delaware statutory trust. How much equity was raised, meaning how much did they get from the investors, and what was the program acquisition price. So you see the difference between the program acquisition price and the total equity raised. They probably took on some debt because of that, but also remember, because and the program acquisition price is going to be more because they have to cover all these fees and expenses that are up front. Okay, so, and then after that you have the property sales price, and you can see what they list as their average annualized cash-on-cash return and a total return. So I think one of the things I want you to take a look at is I put all these little greater than and less than symbols here between the program acquisition price and the property sales price. So if you look at all the ones where I put those little greater than, it shows that the program acquisition price was actually greater than what they sold the property for, right? Because they had to cover all those fees. So look at how many on this page have that they actually could not cover the total program acquisition price with the sale of the property. Now here I want to show you something that I was kind of playing with to try and figure out what the real rate of return is on these properties when you take into consideration all these variables as far as what, kind of figuring out based on the monthly distributions and the sale proceeds. So as you can see right here, it shows total return equals distributions plus sale proceeds divided by amount invested. Well, in order to figure out what the distributions were, I had to kind of plug that number and remember some of my algebra from high school. So I figured out and that the distribution should be the total return times the amount invested minus the sale proceeds. So I'm going to put in some numbers, some real numbers from this page from the Private Placement Memorandum, and we'll kind of take a look and see how things work out. So I'm just going to do a few, otherwise this video is going to run really, really long. So here we have one that's an 84-month hold period, number of periods, which is pretty average because on this page the average hold is about 87 months, which comes out to about 7 years. Okay, so consider that when we're thinking about liquidity, about 7 years of all the ones on this page. So 134.64% is what's listed. What's listed for the total return, the distributions. That's my calculated number. Sale proceeds is the property sale price. So sale proceeds were $18,275,353. Amount invested was your total equity raised, 11,490,000. Number of periods, I said, was 84. And the program acquisition price was $20,290,000. There we go. Okay. And then if we come over here, we figure that our average return here was about 0.6% per year. That's pretty. That's a pretty meager return, because again, this was one of the ones where the property sales price was lower than the program acquisition price. So let's take a look at one of the ones that looks pretty good. One of the ones that looks really good here, we had total return of 121.27%. Again, that's a calculation. Sale proceeds. Let's see. Sale proceeds is 11,940,439. The amount invested was 65,14,493. Here, hold period was 23 months, so they must have found a buyer and gotten a really good deal for the property. And the program acquisition price was 11,308,080, and that's key also here. So we see the program acquisition price to the property sales price. They held this property for less than 2 years and sold it at a $600,000 profit. Okay? And by doing that, made quite a good chunk here. See, that is about average of 21% per year. Okay, so that sounds like a pretty good deal, but there are very few of those where they have a large appreciation in a short amount of time. So also you can kind of keep in mind here that what we're doing here is this is not investing in a business. This is not investing in managing real estate. This is essentially speculating on real estate. Okay, so that's kind of a different thing. And if you're okay with that and you understand the risks, well, be my guest. Go ahead and do it. Let's take a look here. Here's another one. This one's kind of a long one, and it has 157.46%. Total return. We got our sales proceeds are 14,500,000. Okay. Amount invested was 84,000,000. Total hold period was 159 months. That is a long time that you had your money tied up. And program acquisition price was 17,250,000. And we take a look, and we basically made nothing because our program acquisition price was less than our property sales price. Okay, let's take a look at, maybe we'll take a look at one more here. Let's see. See if we can find one here that has makes a little bit of profit here on their program acquisition, or their property sale actually is higher. So let's see. We got total return here, 191.46. So they're going to say, wow, look at that, 191.46% total return. You must be really happy. Yeah, but it's over 138 months. Okay, so you made it essentially, and that 191%, that includes getting your original money back. Distributions, that's our calculated number. We have sale proceeds. Sale proceeds were 12,200,000. Amount invested, this is the total equity, 6370. There's a 138 months again, and program acquisition price was 12,048,350. So we made about 0.11% per year, even though we sold the building at a profit, because they held the building so long. And one of the things that we'll talk about a little bit more later is that in order to qualify as a Delaware statutory trust, they can't really do major capital improvements on the property. So, like I said, they really are just speculating on the real estate market. It's not like they're going in and buying distressed buildings and totally renovating them and then selling them at a profit. That's not what a Delaware statutory trust does, because if they do that, then they would lose their standing as a Delaware statutory trust. Now, an REIT could do that, but they wouldn't have that standing to be eligible for a 1031 exchange. Okay, now I was playing around here again, looking at like a real rate of return here, and we said, okay, well, how much would we get? Let's say if let's say if we took our money and invested it in the, let's say we just took our money and invested it in the stock market over the last few years, how would that come out, right? Because, so let's say that we've got $1 million and we invested it in the stock market for 10 years. And we'll look and I'll say, okay, well, the Vanguard S&P 500 index since 2000, which is when it was formed, if we put that money in for 10 years, what $1 million would have grown to $1,647,607. Okay, and we're keeping in mind here that this was not a total bull market, because we had a massive crash in 2008. So that's all baked into that. Okay. How about if we just took our money and invested it in an REIT index? Okay. So we still want to be in real estate. And now I'm not advocating investing the whole amount in an REIT, even though it did have a really good return over the last 15 years, because that is still a little bit more exposure to the real estate market that I would like. But we'll put that in just to take a look. Had that in, put $1 million in. After 10 years, you end up with $2,977,947. Okay, so it's not just about getting whatever the return is there. It's also, what are your options, and also thinking about liquidity, because if you invest it in any of these other vehicles, that if you need the money, ideally it would be you would keep it in for the long term. But if you need the money, you could pull it out. With these Delaware statutory trusts, you are locked in. If it's 23 months, well, you're only locked in for 23 months. If it's 159 months, you're locked in for 159 months. And then keep in mind also, if they're short term, like that 23-month one, or I did see one that said 18 months. At the end of those 18 months, you pay about 1.5%, which we talked about in the video on fees. When it comes out, and I actually put that in here. So you have to think about, okay, would our total return be after that 1.5%? And then in order to roll it into another Delaware statutory trust, you're going to pay another 12.5% up front. Okay, so let's keep all that in mind. Hopefully this didn't run too long, but I did want to show you a couple things that I had done on the spreadsheet there, so that you can see in real time if we plug these numbers in, and kind of what our returns would be and what they would be kind of relative to some other possible investments. So we're going to pretty much wrap it up right now, because otherwise this video is going to get way long. So in the next couple videos, I'm going to talk more about the issue of liquidity, and also want to talk more about the fact that this company is not a fiduciary with your money, and what it means to be a fiduciary and how important that is. Okay, so if you enjoyed this video, hopefully you give it a thumbs up, and I'll see you shortly.